Welcome back to the Williams Real Estate Channel. I'm your host, Geordie Williams, and tonight we are running through the November 2024 property market update, the Australian property market update. So stay tuned. We'll run through some key data points, and then I'll give you a forecast where I believe the markets are heading based off the 18-year land cycle. So to kick it off, we will start with the CoreLogic data indexes for November. So for the month, we continue to see Sydney and Melbourne soften. Brisbane, Perth, Adelaide continue to lead the charge in terms of capital growth. Hobart softening and modest growth out of Darwin and Canberra, with an overall combined capital growth for the month of 0.1% for the metro markets and combined regions 0.3%. So as you can see, the total return for nearly year to date or 12 months, the best market this year has been Perth with 26.4%, followed by Adelaide 18.4%, Brisbane at 16.6%, then Darwin 7.7%, Sydney at 6.5% for the year, Canberra 4.4% for the year, and in last place, Melbourne at 1.4%. So Melbourne is tracking in the fifth most affordable metro market, which is really unheard of. Historically, I mean, even on the screen, they've got CoreLogic's got it listed as the second, but if you look at the median values on the right-hand side, 776,000 median house price compared to, I guess, Sydney's always number one based off history at nearly 1.2 million bucks. And then in second place, we've got Brisbane at 886,000, Adelaide in third place at 813,000, followed by Perth in fourth place at 808,000 medium value, and then Melbourne at 776,000. So we're finding great value in Melbourne right now. It is not often that you see the cracking value in Melbourne. It has had a hard run the last few years. So we are an advocate of, it's not what, when you buy a property, it's not about the previous 4 to 5 years of what that market has done. It's about what the potential future growth is. Because when you buy the property, you're buying its future growth potential. You're not buying of what it has been historically. So most people like getting into markets that have had solid growth over the last 3 to 5 years, but they're not necessarily the markets, such as Brisbane, Perth, and Adelaide, that are the best markets to get into. You want to get into the subdued markets because typically markets go through 10 years of subdued to flat growth and then 5 years of explosion where they go up 150 to nearly 200%, like what Brisbane, Perth, Adelaide are experiencing now. So you want to get into the markets after they've had a subdued growth for a number of years, because it's only a matter of time that they'll then hook into their next growth cycle rather than getting carried away with the herd. So as you can see, the data, it's becoming more and more euphoric in Brisbane, Perth, Adelaide. But I believe these markets, the risk is becoming more so to the downside, because at some point those markets will top out, then they'll soften, and then they'll go through a protracted 10 years of modest to negative growth, when Sydney and Melbourne will then become the leading markets for capital growth. So we're getting very excited for Sydney, Melbourne, and it's really the only two markets we're now focusing on. No longer focusing on the regions as well. We're feeling the ripple effect now starting to come back from the regions. So, and as you can see, just talking to regions, Victoria is softening. Regional Victoria, regional New South Wales is slowing. Queensland, South Australia, and WA are still going strong, but it will only be probably another, I'd say probably another 2 or 3 years by the time 2 to 3 years, and then those markets will top out, and then or probably 2 years, I'd say, and they'll top out, and then they'll start to soften, and then within the next 2 years, Sydney and Melbourne will then become the leading markets again for capital growth. So it may be, I guess, scary to think about getting into Sydney and Melbourne now when they've been, I guess, negative this year and subdued compared to Brisbane, Perth, Adelaide, and those regions. But in order to capitalize and get those capital gains from Brisbane, Perth, Adelaide, and their respective regions, you've need to get into those markets a couple of years ago. So we're now, as I said before, only focusing on Sydney and Melbourne for probably the next 4 to 5 years before we then look to sort out other markets that are more subdued, that have had softer growth in the coming years. So changing a bit of tune this month, as we come through the final stages of the land boom, and now that we're entering the winter's curse, you'll see that markets will all start to hit all-time highs. ASX 200, this is the Australian stock market, now hitting all-time highs, similar to what happened in 2005, 2006, where we had a solid run for the last couple of years. A lot of speculation is going to start kicking into gear now the next couple of years. So now is the time to definitely be cautious with your investments if you're looking at stocks. But also, this is a leading indicator for the last couple of years of the property markets, because this is forward prices in future gains. Similar in the States, the Dow Jones is now hitting all-time highs, which is going to just continue to suck in more investment and speculation and provide more confidence in the markets, and they'll all filter down to the benefit of land price. Bitcoin, I mean, it's been crazy last month, hitting nearly 150,000 a coin. I mean, I'm not into Bitcoin. I'm not an advocate of this asset class. I mean, I wouldn't be surprised if Bitcoin and cryptocurrency goes to zero during the next land-driven downturn, as it doesn't have any earnings, and it really, I don't know if anyone really understands what it is, but it's not tangible. You can't physically hold it. You can't like real estate, like a hard asset. It is a liquid asset, which I don't believe most people really understand what it is, and it hasn't really gone through the test of time and hasn't gone through the likes of a land-driven downturn. So it will be very interesting to see how it stands and if it can survive. And potentially this may be cryptocurrency and even private equity may become the weak link in the financial system globally, which could ultimately become the tumble or the tumbling blocks, which may bring down the financial system come the end of the cycle. So this is, I guess, a classic setup that we're seeing play out both in the stock market and cryptocurrency, and it's going to suck in a lot of punters over the next couple of years. But we are sticking to obviously property, and it won't surprise me if even banks start using cryptocurrency to use as security to allow people to borrow against to then go and buy property, which will ultimately feed the property market and the land cycle even further and higher come the last 2 years of the winter's curse, and speculation will just hit all-time highs. So watch this space. It's also a very unregulated market. So I think regulations will come in post the next land-driven downturn, but until now and then, it's really a booming market that's going to all feed on itself, and it will be um, a rising tide that is going to lift all ships. But as Warren Buffett classically says, it's not until the tide goes out do we discover who has been swimming naked. So we stick to property, but this ultimately will impact the property market as it impacts confidence in the market over the next few years. You'll feel the confidence come back as people begin to feel wealthier, as their stock portfolio, their crypto portfolio, their property portfolio continues to expand, and people become more wealthy. And then people will start to forget the fundamentals and just buy anything, any asset, because everything just starts going up in value. So now is becoming more critical than ever to be cautious with your investments and not get carried away with the herd. The Reserve Bank of Australia has got their next RBA meeting next week, I believe, the 10th of December. So we'll see what they do with the cash rate, but it's currently at 4.35% as of November, and I wouldn't be surprised if it potentially goes up a couple more times from here, as we are in a similar point of the cycle like in 2005, where we came out of COVID, which was like similar to the dot-com bust, and we've had higher inflation because they printed money and set off inflation. Now they're trying to rein it back in by raising the cash rate, and we're still not there yet with inflation. And over the next couple of years, with demand growing, domestic demand growing in Australia, and a lot of net migration, and now that we have the stock markets and crypto hitting all-time highs, that will as well filter down to growth, and inflation is going to remain sticky and elevated, I believe, until the market turns through the next land-driven downturn, which won't be until 2027. And based off history, rates continue to go up until 2007. And then once we entered the GFC in 2008, that's when rates got dropped again. So based off history, if history doesn't repeat exactly, but it rhymes, and I don't believe the RBA is going to be in a position to be able to drop the cash rate until probably late 26 or early 27, as they use the trim mean inflation. So inflation has dropped to 2.8%. It's basically touched into the top end of the band, but they use this trim mean seasonally adjusted inflation rate, which is still sitting at 3.5%. So it's still a fair way off the mark. They want to see it consistently held at 2.5% for probably at least 6 to 12 months. So we're a fair way off it, and the RBA is not expecting the trim mean inflation to get to that 2.5% band within the 2 to 3% until the back end of 2026. Come then, the market will be topping out anyway, and we'll be entering the land-driven downturn come 2027, and that's when I believe inflation will come back down, which will then ultimately bring interest rates back down. So hold tight until at least 2027, and now's the time to be putting your house in order, cashing up, not being over leveraged on your debts, because you need to be able to stay in the game for the long term rather than trying to go as hard as you can at this point of the cycle. It is becoming riskier to carry high levels of debt, even though over the next couple of years, banks will start loosening lending policies as they're starting to earn higher profit margins as the cash rate's higher. So they will be able to take on more risk. Um, Next one is another key point that the RBA is keeping track of is the Australian unemployment rate. So this is a good indicator to keep an eye on, and what the RBA actually keeps an eye on is it's still at pretty low levels based off history. And if it were to spike or run to higher levels, such as 4, 5, 6%, that's when they would look to reduce the cash rate. But as it's now consistently maintaining at around 4.1%, that's still pretty low level. And if it were to drop, which Michelle Bullock, the Reserve Bank governor, has made mentions of um, during her previous last couple of days in some press conferences, she wouldn't be surprised if it drops low again. And if that was the case, then the labour market is strong and getting tighter as we got more migration coming in and more jobs are being created. If that happens, then that will be inflationary, and potentially that will be a leading indicator that inflation will remain higher and elevated and potentially go up, which will ultimately require a higher cash rate. So that's what we're keeping an eye on. The next is this is the US home builders, key home builders in the US. So I like to keep an eye on this as based off history in um, 2005, 2006, these stocks began to soften over 2005, 2006 as a leading indicator as they were pricing in reduced earnings. And then the GFC hit. So they're all hit the largest, I guess, home builders on listed on the US stock markets. They're still hitting all-time highs, but it would be a good leading indicator that the market's due to turn once these stocks begin to have negative growth over a 6 to 12 month period, which will happen in the background. Most people won't actually take much note of it. Um, the market will continue to keep booming on, the overall stock market and the property market, but these stocks will begin to decline, and that will then be an indicator that the land market has topped out and is then due for the land-driven downturn. So watch this space. I'm expecting them to start declining over the course of probably mid 2025 and into um, early 26 for 12 months, and then come mid to late 26, the market will top out, and then come 2027, it'll become mainstream that the market has entered the land-driven downturn. So, just trying to hide this. Uh, sorry. So the 18-year land cycle, we are now set away in the winner's curse. The last two most speculative years of the cycle before we see the top is forecasted to top out in the States in April 2026. So we use this as a framework. I tend to harp on a lot about this, but I feel this is the most powerful way to invest, not just property, but you can invest in stocks, commodities, everything. You can use this framework to work out the best asset class if you overlay the framework on over history of whatever asset class you select. But we are now using this overlaying this on 20 years of sales data in the metros, the regions, suburbs, even down to the asset type. So if it's a unit, villa, or townhouse, or a house, or even blocks of units, to see how each individual asset class performed. And we're finding cracking opportunity now in Sydney and Melbourne that began to outperform in 2006 in certain pockets in Melbourne and in 2006, 2007 in Sydney. So based off history, we're in a similar point of the cycle in 2005. So that's why we're selling our seeds now in these markets in preparation for their next growth cycle. And we are no longer focusing on Brisbane, Perth, Adelaide, and the regions as well, as the regions have already started to begin their ripple effects back to metros. And you will see Brisbane and Perth and Adelaide will continue to have growth. I mean, Adelaide's probably 15% from the top before it'll top out and then start to cool. Brisbane's probably got another 30 or 40% growth. Perth's got another 40% growth for the top of the market. However, um, these markets that still have growth, the risk is becoming more for the downside. You have to overpay, and we're now focusing on Sydney and Melbourne in preparation for their next growth cycle, and even uh, helping clients reshuffle portfolios that may have had a good run in these markets and even in the regions. I mean, even personally, I'm looking to offload a couple of properties in regional New South Wales next year to then reinvest the capital gain into Melbourne and Sydney, as I see better value in Sydney and Melbourne now, and rather holding an asset worth, say, a house worth 500,000 in the regions for the next 10 years at that same price point, sell it down, pay down the debt, raise cash, then reinvest into 2 or 3 or 4 assets in Melbourne and Sydney that are set for their next growth cycle. So allowing to take money off the table, reinvest it into other markets, and then continue to get the future capital growth in these markets. Yes, it may be scary to some people to be investing in Sydney and Melbourne these days, as you will see, I guess, a lot of negative media on these markets. They're now softening, but that is the best time to buy. Be greedy when others are fearful, and fearful when others are greedy. We are picking up units for sub 300 in Melbourne and sub 350 in Sydney. And these days it costs minimum 600 grand to build a unit and up to $1 million for the top end. So we're buying for half the intrinsic value with strong yields of 6 to 7%. So it's only a matter of time that they'll commence their next growth cycle, and the prices will then come back to their intrinsic value and then even exceed it, like what we are seeing now in Brisbane, Perth, and Adelaide. So don't get caught up with the herd, caught up with the FOMO, and rush into the overheated markets and the regions, as especially the regions have had, I mean, their solid run over the last couple of years, and they're hitting their limits. And New South Wales and Victoria is already starting to soften, and it will only be a couple of years before Brisbane, Perth, Adelaide, and their respective regions top out and begin to soften. Further to that, commercial real estate now is also becoming more risk to the downside. People typically in the second half of the cycle historically, and as we go through this final boom in 2025 and 2026, will chase yield, as yields in residential real estate become harder and harder to find. You can still find yields of 7, 8%. They're still out there. They are hard to find, but it is becoming harder to get those yields, hence why a lot of people transition into commercial. The trouble is with going commercial at this point of the cycle is, sure, you'll get a strong yield, but Once the market turns, and historically in 2008, 9, 1991 recession we had to have, 1972, and if you keep going back to the previous land-driven downturns, 1955, 1933, Great Depression, during these large land-driven downturns, businesses go broke that are carrying too much debt. And if you buy a commercial asset and your commercial asset is valued based off its earnings, so it's valued based off the rent the business is paying, you're getting a strong yield once the market turns. And if the tenant goes broke, the business goes broke, and you then have no earnings, the commercial asset is then worth land value. So you may pay a premium now and towards the top of the market in 2026. And then if the business goes broke, which is pretty likely, or 50% chance, it can take up to 4 years for the reckoning of the land-driven downturn, like what happened post-GFC from 2007 to 2008, 9, 10, 11, 12, to recover out of that. And during that period, it is very difficult to replace a tenant because lots of businesses are feeling the pinch. Rents drop. So history shows that commercial can correct anywhere between 50 to 70%. So even if, I mean, personally, I've got 17 residential rental properties, 17 leases in residential, and I wouldn't feel comfortable now going commercial, even if it's $1 million, small um, factory warehouse in a metro market, because the chances are higher that you'll lose the tenant in the next land-driven downturn. And if you pay $1 million for a commercial asset now, that's providing a 6, 7% net yield. In the next land-driven downturn, that same commercial asset could be worth 500 grand if it's vacant. So I would rather pick up a commercial asset towards the back end of the major land-driven downturn, towards the back end of this decade, so 2028, 29, 30, where you get it for 50 cents in the dollar. Similar to what happens to the stock markets around the world, they typically take a 50% correction. So there are assets that, yes, you may be able to get a better yield, but once the market turns, the story can be completely different. So there's nothing more stable, more robust, more resilient than the residential real estate market, and especially the more affordable end, which is the space we like to play in. So units for sub 350, between that 250 to 350 mark, houses for the 350 to 400 mark, duplexes, that's 2 units on one title for the 500 grand mark, blocks of units for the 600 grand for 3 units on one title, and 800,000 for a block of 4 units. So very affordable land, well under the intrinsic value, strong yields of 6 to 8%. And during the land-driven downturn and the mid-cycle slowdown, there is a rush to affordability. So people think it's a rush to quality. It's more so of a rush to affordability, because people can't no longer afford the $1 million plus apartment or the nice fancy house if they are owning that or renting it, because they may have lost their job or their business has gone broke. So they need to sort out affordable accommodation. And during the times where we have tough times, being a recession, the more affordable end gains the most demand. So in my experience throughout the mid-cycle slowdown, all my property that I've bought and helped clients more than doubled in value, because the demand shifted for the affordable end. So even when the top end's coming off and commercial assets will be coming off and the stock market and crypto will be getting hammered, the affordable residential real estate will be leading the charge in the markets that are set for the next growth cycle, which are Sydney and Melbourne. So if that resonates with you, shoot me an email. Happy to chat around your plans, where you sit in the market. Happy to set up a time, get you on a phone call, get you on a Zoom to run through 20 years of sales data of your existing properties as well and link it to the 18-year land cycle and show you how the growth may play out for your existing portfolio over the next 5 to 10 years and how you may best want to navigate and play the markets to continue to keep growing. Because over the next couple of years, yes, it's going to be turbulent, but it's going to be the best time in our lifetime to buy over the next couple of years, especially once we enter the land-driven downturn. As always, this content is general and by no means personal or financial or general advice. Prior to making any investment decisions, you need to consult with third-party advisors. I operate as a buyer's agent, though. If this resonates with you, shoot me an email and we can go from there. Thank you for watching. I'll catch you on the next one.